Welcome, everybody. I'm Julianne Smith, Chief Development Officer of the Americas for IHG Hotels and Resorts. I get the privilege of moderating this esteemed panel. So before we get started with some of the questions, we'll go down the line with introductions, and then we'll leave a little bit of time for some audience questions. So I'll kick it over to you.
Great, thank you. J.B. McKibben, President of McKibben Equities. We're a 100-year-old family company, the last 75 of which have been primarily focused on hospitality. And today we have three major divisions. We have McKibben Hospitality, which is our hotel management division, just over 100 hotels under management today. We have McKibben Places, our project management group, and they handle our internal as well as third-party project management for ground-up and renovations. And then lastly, McKibben Equities, where I'm focused, raising capital, placing capital. Traditionally, that's been through ground-up development. And then as of late, we've been raising funds for an acquisition model and purchasing hotels in addition to ground-up.
I'm Julie Richter. I'm Chief Financial Officer for Concord Hospitality. We're based out of Raleigh. I thought our 40 years was good, but now it seems like we're just getting started. So we are a management and development company focused solely in the hospitality industry, and then we have a strong emphasis also on real estate ownership through affiliated ownership. And I spend most of my time building the capital stacks for the deals that we do and putting together joint ventures and so on.
Great. Good afternoon, everyone. My name is Noah Silverman. I am the head of I work at Marriott International. I lead our U.S. and Canada development team. I have the pleasure of working with all of my fellow panelists up here through their interests in our hotels. But what we do at development at Marriott is work on adding new hotels to our system. So it's great to be here. And Julianne, nice to sit on a panel you're moderating. Usually you and I are both sitting on the panel together. So it's great to be with you. Thanks for having me.
My name is Wes Whitman. We have a real estate private equity firm called Whitman Peterson, and I'm the co-founder and co-managing partner of Whitman Peterson. Really honored to be on this panel with these wonderful people that we get to interact with often. Our business, we invest across asset classes, so we do everything from last mile logistics to multifamily and all sorts of rental housing, to a variety of things within hotels. So we do everything from economy and mid-scale extended stay, which we'll talk about today, to traditional select service hotels, to everything to outdoor experiential travel with a brand called AutoCamp that we have helped grow across the country. And so we do a variety of different things across the real estate sector. We manage commingled funds on behalf of large institutional investors.
That's great. And I apologize for my phone being on my lap. I need the flashlight in order to see my notes, so sorry for that. So the first question is for Wes and Julie. You've recently partnered in a pretty material way. What aspect of the development industry on the hotel side are you focused on?
You want me to go first?
Sure.
Okay. So we have had the blessing of being partners with Julie and the team at Concord for over 10 years now. We have done a variety of different things, from acquiring hotels to developing hotels, and we've done a little bit of everything even in the last couple of years together. We're primarily focused, and have been for the last 5 years, on what the industry is sort of calling economy extended stay or mid-scale extended stay. I'm really trying to get the word apartment into the vernacular so that cap rates will go down by about 150 basis points on the valuations of the property. So if you guys can help me spread that, we'll call it short stay apartments. No, but that's what we're primarily focused on together. We've done a lot, Julie, and you can talk about what all we've done together. But working with the Concord team has been just incredible, and we're excited about all we're doing.
So as Wes said, we have a pretty robust pipeline related to the economy and mid-scale extended stay, but we also have a full-service Hilton in the ground that we put in the ground last fall, and we've acquired assets over time, and Concord, not always with Whitman Peterson as an investment partner, also has several other kind of select service assets in the ground that we're working on and pipeline, and tomorrow we're opening a large Westin hotel north of here in Gwinnett. So we run the gamut from, $15 million projects to $115 million projects and everywhere in between.
That's a great project too, and a testimony to the strength of, secondary and suburban markets in major urban areas. So I wish you a lot of luck with that.
Thank you.
With that West End. A great segue though in terms of the extended stay that you're focused on. Noah, Marriott recently launched Studio Res. We're seeing a lot about that in the press. How is that going? How's the pipeline for that segment? And is there anything else that you're sort of focused on in that arena?
Yeah, well, thanks to folks like Wes and Julie, it's going great. It's actually a little bit of a full circle moment. I was telling Wes that I think the first time we sort of signaled that Marriott had intentions to enter into the mid-scale extended stay space was at a panel here a couple of years ago. We then, sort of launched it with a project name at the NYU conference last year. The Studio Res name came shortly after that, and the interest has really been pretty extraordinary. I think as Wes mentioned, we weren't obviously the first to get into the space, but it is a space that we were not in previously. We saw through the pandemic the strength and growing strength of the extended stay segment, and although we had brands that played in that extended stay segment, they kind of concentrated themselves with TownePlace Suites in the upper mid-scale tier, or with Residence Inn and Element in the upscale tier, and we knew there was greater depth and breadth to that extended stay market than those brands represented on their own. So, two of the more recent brands that Marriott has launched are Studio Res in the mid-scale extended stay space, and Wes is exactly right. I mean, we talk about it as a mid-scale extended stay hotel. You could just as readily call it, moderately priced apartments that are rentable by the day, week, or month, or longer. Hopefully not just the day. That does do some things to the business model that I don't think any of us want. But it was a similar sort of philosophy that also drove us into Apartments by Marriott Bonvoy, which was taking the sort of an extended stay or apartment-like product to a higher tier than we had with both Residence and Element. So it's been both have been successful so far, not surprisingly, given the success more broadly and the entrance into the mid-scale extended stay space. More volume there, as we would expect to see right now. But it's been kind of it's been exciting to watch it both come to fruition. Watch these guys get the very first Studio Res shovels in the ground in Fort Myers, and hopefully much more to come.
That's exciting. So, JB, your firm focuses on development, operations, project management. You pretty much do everything on the development side. Ownership. What was 2023 like for you from a development standpoint, and then what are you focused on this year, if it's different or the same?
Yeah, if we look across the divisions, it's really a blend. 2023, from a development perspective, you have interest rates start ticking up, and really we saw inflation through construction prices increase rapidly. We had one project that went from 50% construction set to 100% CD set, go up 30%. And so you get pretty baked into a project that all of a sudden doesn't work, and typically you'd only see sort of a 5% gap between those two, or is what you'd expect. So poor timing on that one, but we're continuing to chip away and make projects work where we can. We actually broke ground on a project in Cape Canaveral this year. We've got a Moxie that's underway that's going to deliver this summer. And we continue to try to put out capital where we think it makes sense on the new construction side. And then we've also shifted gears. We've got a new acquisition fund, which is a new thing for McKibben. We've currently raised around $32 million with a target of a $50 million raise. We bought our first hotel at Hampton Inn & Suites last year, and we've got hopefully one we'll have under contract imminently. And the goal is to really have a deal sort of once a quarter and pace throughout this year. So we'll be net acquirers this year through construction and acquisitions. We'll grow, and just a few dispositions.
And on the acquisitions, are those stabilized? Do they require renovations? Like, what's the plan there?
Yeah, so it's really a blend. We're not looking for anything that's inherently broken. We're fine with renovations and the associated risk because we have our project management business. We're very busy with renovations, both internally and for third party. We've seen a huge shift in need from construction service management to renovations for, effectively kicking the can in the industry for 4 years. And now everyone is, the brands are pushing, right, to get caught up. And there's a limited number of project managers, designers, FF&E, and so we've really seen that pivot happen.
Yeah, definitely. Wes, are you continuing to focus on extended stay this year? Do you think you'll diversify what's happening at your organization?
That's where our primary focus is. It's on the extended stay and then this experiential lodging concept, where, outdoor travel and travel to national parks and other places continues to be a really strong trend that we don't think is going away. So those are the two places, but we will very opportunistically do other things. So we recently acquired Spring Hill with Concord. It was adjacent to a courtyard that we own and that Concord already managed, and so we had some operating efficiencies there. Paul Novak just walked out, but we're also developing this full-service Hilton on the campus of the Mayo Clinic, and so there's very select things that we, on the Whitman-Peterson side, not to speak for the Concord side, because they'll do a lot more, but those are where those areas we're focused on.
Yeah, that's great. And it's nationwide for you.
Nationwide.
Right, yeah. Julie, you're the CFO at Concord, so you see the good, the bad, and the ugly regularly. How are you putting your capital stacks together? Are you going out for traditional financing, or what does that look like for you?
Right, so everybody knows, right, the banks are tough. I think an earlier panel, one of the bankers said if you have to have a relationship, and if you don't now, don't come talk to me, right? So definitely the banks are kind of hit or miss. It really depends on the bank and what their situation is and capacity and how things are rolling off. And then, there's the debt funds on kind of the other side of cost spectrum. And then in the middle, we've seen some family offices kind of get into the business and start to borrow from the credit side or like private wealth side of banks. So it's not on a bank CRE book. That's kind of their A note, and the private wealth office puts some money on top of that to make a first mortgage loan, and that's priced kind of between the two. So that's how we got, for instance, our Hilton in the ground last year was that new to us anyways, entrant into the marketplace. So the debt money's out there, it's expensive, it makes it hard when combined with the increased construction costs and so on to make all the deals underwrite, but there's enough out there. And then from an equity side, we're seeing we need probably slightly more equity than we historically needed because as well as cost being higher, the leverage is just a little bit lower in those various pieces of the capital stack. As well as coming out of, we were never a high levered company or, from a deal by deal basis, we've always been pretty conservative, but you come out of COVID and you really look at it and go, don't want to go there again, right? So I'm comfortable with less leverage than we used to be as well, so.
And that's all on the new development side. So when it comes to the acquisition and disposition, you're just selling at this point. You're not acquiring existing assets, right?
Well, as Wes said, we acquired one last year. We've got, offers out on multiple deals right now to acquire things. So we are and hope to be an active acquisitor as well. I don't know that we always adjust like our return thresholds for development risk versus acquisition pricing and so on. And so sometimes we're not necessarily the highest bidder, but in the right place for the right deal, we're looking to acquire as well.
Yeah, so that conservative acumen that you apply on the new development side, you're applying on the acquisition side.
And looking for similar returns where there are other people out there who are needing lower returns than what we look for.
Yeah.
So.
Noah, because of all these headwinds, what does it look like for your pipeline conversion versus new development? How do you see your franchisees getting deals done, both on the conversion and the new development side?
Well, it's definitely a different story depending upon sort of which path you're on, right? New construction right now is both difficult to find the capital and difficult to make the, difficult to kind of put it together in a way that works, right? That's a little bit, I think, of what you've, what Julie just ran through. At the same time, we still, and thankfully for us, we still see a steady stream of applicants who are interested in our brands and in opportunities, and that's great for us and great for our industry, and it's rewarding that there are so many that still, despite the hurdles, remain committed to finding ways to get new projects done. What we're seeing after I keep describing the way it works with us, though, like they come into, if we think of sort of the brand, whether it's you guys or us or any of the other brands, as a kind of stop on the train of development, we're a relatively early stop, and we're still seeing kind of the trains pull into our station like it's the bullet train from Tokyo to Kyoto, but they leave our station a little bit more like the steam engine crossing the plains back in the 1860s, right? So we are still seeing deals get financed. We are still seeing new construction start, but we are seeing that and have been now for really since the onset, maybe not quite the onset of the pandemic, because there were things that were going then or just ready to go. So maybe 60, 90 days kind of after March of 2020, things kind of started to slow down, and we are still seeing new construction starts at about half the clip, roughly, that we were seeing prior to the pandemic. And although the factors that are driving that pace today are different than they were back in 2020, the outcome is the same, which is that new supply coming through those new construction projects is happening slower. Conversions, not surprisingly, in an environment in which it is harder to get new deals to pencil or new construction to pencil and get done, there's a lot of activity around conversions. I think we, like most of our kind of other sister brand companies, have been very focused on conversions as a means of helping to facilitate growth. Most in the room who are owners should be taking full advantage of the competitive natures of the brand companies in wanting conversions to be part of their system. We feel fortunate to have a bunch of brands that we think work well for conversions. And those are a little bit easier to get done if it's a cash flowing asset, and maybe there is a lot of capital that's still very interested in this space, and if you happen to see a situation that maybe is a bit broken, or it's a hotel that needs some capital, and maybe the existing owner is dealing with a situation across their portfolio where they've got the need to dispose of some things in their portfolio to deal with issues elsewhere. There are opportunities out there that can create, that I think present good opportunities for us as well as good opportunities for those that are looking to acquire.
Yeah. And it does feel like, compared to this time last year, that things are stabilizing a little bit. People are sort of settling into the new normal as it pertains to their capital stack and their returns expectations. So I do feel like the volume in the last few months has picked up a bit in terms of whether it's new development or conversion, because it feels like, this time last year, like, I don't know, interest rate's going to go up, what's going to happen? And now it feels like, okay, it doesn't seem like it's going to go up. Maybe they'll come down, but...
Still, I don't know, but at least not up, right?
Yeah, exactly. Still not a total wild card.
Right.
Yeah, knock on wood. Yeah, good. So when I think about cost and the implications that has, I do think about F&B, because in the hotel space, we haven't been known for being profitable on the F&B space. So I think about your portfolio, JB, and you have a number of hotels that have really great, successful F&B outlets. I think about the Kimpton in Nashville and what you have going on there. So what's your perspective there? How are you keeping those profitable? Are you doing anything different that you've done in sort of previous times?
Yeah, when you look at F&B profitability, obviously we have a lot of hotel brands, free to guest breakfast, right? So that's just a straight cost, straight amenity. And as you move up to more prototypical Hilton Garden Inn, Courtyard, and our Hilton Garden Inn F&B, we like to brand those and make them stand out a little bit, sort of in the 10 to 20% range. We're still there. And we really try to drive banquet. We can get margins, gross margins on F&B up to 50%, right, if we have large volume of banquet in place. But getting to sort of the independently branded rooftop bars and outlets, we target sort of a 30% range in margin, and we really focus more as an organization on beverage forward operations. So target is 70% sales from beverage, right, 30% from food, and those allow us to maintain a decent margin. The more we lean towards full service sit-down restaurant, generally we're going to see those margins go down. So generally speaking, when we're looking at new product development, we tend to lean towards sort of, the rooftop bar, sort of destination outlet that's more beverage focused, because it is profitable and a lot of these outlets are extremely expensive to develop. So you do want to get some return before even counting on the incremental ADR driver that you're going to get on the room side of the house.
Have you had challenges with the liquor licenses in any of the markets that you've been entering into?
Other than it always being a pain to work with the local jurisdictions, I wouldn't say we've run into any brick walls in terms of getting our licensure, but it's never a fun process.
Yeah. And Julie, I see you nodding a lot about the beverage forward sort of concept. Is
B&F. We focus on B&F, right?
B&F, yeah. And I see that in a lot of your hotels as well. Yeah. So, Wes, you're focused on the extended stay, as we talked about, in the development side. Are you also focused a little bit more on conversions? And if so, how are you putting your capital together? Like, what does your capital stack look like? How are you raising money?
So we, our money all comes from our fund. So we go and raise capital every few years from large institutional investors, whether it's pension funds or endowments, foundations or others, and then we deploy that over a 3 to 4 year period. And so we are, whether we're developing or whether we're acquiring, really depends on a lot of things. Some people say, could you really be in both businesses? I think as we consider whether we're going to acquire something or develop, obviously basis is the most important question, right? Like if you can acquire something for a lot lower than it would cost you to build, then you would of course acquire that same asset. But what we've seen, and probably like a lot of you in this room have seen, is that in many cases the assets that you can buy at a great basis are not necessarily the same assets today, at least, that you want to own long term. And there might be in a product class where the existing stock is 30 or 40 years old, and that's maybe not what the customers want. And so when you look at this, economy or mid-scale extended stay, there's a lot of mid-90s product. There's a lot of older product. If you think the customer wants something newer, then your option really isn't to go and acquire and convert at scale. So that really is a development focus for us. If we're doing outdoor accommodations, they're really, unless you're going to go buy, we're buying old RV parks and converting them into these cool auto camps. That's really not an acquisition play where you're acquiring something. So, and this is across a lot of different asset classes. There's a lot of product out there where the way customers use the product is different than it was 15 or 20 years ago. And so whether that's industrial or other parts of the real estate business, it's really consumer-led. So if we can acquire a really nice building at a great basis, we will do that all day long. But in a lot of our strategies, we're having to sort of manufacture that product that doesn't exist.
Yeah. So you mentioned your outdoor camps, and that makes me think about diversifying, which I'll get to you, Julie, on that question in a second. Tell us a little bit more about the auto camps and the outdoor experience. I have an RV myself, and that's how we travel. For times it's really hard to get the right RV spot. You got to book it a year in advance. So there really is business there.
It is unbelievable.
So tell us more about that.
At a lot of the best national parks, if you're not there 6 months in advance, the second it opens up online, forget about it. You're not getting in. And then if you go, your options are if you don't get a campsite, or if you don't want a campsite, which a lot of people as they get older, I'm not searching to go sleep on the ground as much as I used to. And so now you go and say, okay, well, what are my options? And in many cases in these national park locations, most of your brands are not represented there, and a lot of the product that's there is 30 or 40 years old and unrenovated. And so the idea of helping people, and a lot of people are intimidated by the outdoors. They don't know, they want to get out, but they don't know how to experience it. And so this company, AutoCamp, has come up with, essentially, they have a multi-year exclusivity with Airstream, and we create customized hotel rooms within the Airstream that are sort of boutique hotel finishes. We put about 80 of them around a really beautiful mid-century modern clubhouse. And so you come and you pass Tesla charging stations on your way to the clubhouse. You go in, you get your key, and then you literally take a little red wagon with your suitcase, and you go to your own Airstream that has your own fire pit. And it's really an amazing way. What we have is a lot of couples where one of the people really loves the outdoors, the other one does not want to sleep in a tent, and it just creates a great opportunity to access the outdoors in a really comfortable way. And so we have those across the country in a variety of different locations, and so that's what we're targeting. The rates people are willing to pay would surprise you. I mean, to have that unique experience, it isn't uncommon in the summer for us to hit a $400 to $500 ADR for that product, and annually to be in the high twos, low threes across the country. So it's a really interesting business. We're in the early stages, and there's some other folks, KSL has backed Under Canvas in the space, and Starwood has backed Getaway, and there's some other people that are providing some unique offerings there. Ours is a little bit more of a year-round product, that it's not a tent-based thing, and so we're, anyway, sorry if that was more than you wanted.
No, I do have one follow-up question.
Okay.
So when you check in and get the key, is it a human transaction? Is there a host there?
There is.
Okay.
There is. I don't think that's going to need to be the case going forward as technology allows us to streamline that. But as people are having this experience for the first time, that one-on-one interaction, okay, where do I go from here? There is a little bit of a high touch in that initial interaction, but otherwise we operate it like it's a limited service hotel.
That's pretty cool. I love seeing our industry diversify in that way. So, Julie, are you at Concord diversifying? I mean, you started the business as a home builder. Now,
Yeah, home building predated Concord.
Yeah.
But yes, Mark was a home builder and a diner owner and an insurance salesman and consummate entrepreneur. No, we are very much wed to being hotel people, hotel experts. But as I said, we over time have gone up and down the scale on what we're working on. So again, this month we'll open a Wood Springs and the Westin, and we've got the $90 million Hilton project in the ground, and putting in a new ESA in the ground, and the brand new Studio Res that broke ground in February, and many, many more of those to come. And so we're kind of all over the board, working on other full service and select service assets as well.
Yeah,
so
that's great. So as Noah, as some owners are diversifying either in chain scale or in sort of adjacent spaces, are you seeing the typical franchisee shift? Is it still your tried and true players like the people up here on our panel, or what are you seeing?
It depends kind of a bit on the space and the segment. Certainly, I mean, we approach our relationships with development partners much like we do guests in our hotels. We don't just like them to stay in our hotels once. We want them to come back and stay at our hotels again and again and again. You invest sort of a time and energy into the initial deal. It makes the second deal, the third deal, the fifth, 10th, that much easier. So we certainly love the idea and are continuing to see franchisees that want to do lots with us. Again, I mean, the deal that we've got with Concord and Whitman Peterson with respect to Studio Res, we hope results in dozens of Studio Reses across the country. So we're super excited about that. Even though, so these are obviously experienced players who know us well from other segments and other brands, who have now partnered with us on this new brand launch, despite it being a new segment, a new offering for us. In fact, they were really collaborators with us even on the development of the product itself because of their experience in the space. But there are also, there are extensions of our business that are bringing us into contact with folks that are not traditional Marriott franchisees, and there are new entrants into the industry new pools of capital, new sources of investors that I think are starting to see and have increasingly over the years begun to see hotels and hospitality as a pretty good place to get yield and look to invest, especially as some other commercial real estate sectors have fallen pretty significantly out of favor, right? I'm not sure I'd run out to build an office building today. On the other hand, our ability, this industry's ability to kind of reprice its inventory, every day has served it quite well in an inflationary environment that has had some costs associated with it in a lot of different ways, but benefits as well in terms of what we've seen in ADRs. So, we welcome all newcomers into the fold in the industry and are happy to see more showing up as well that like and understand and believe in the future of travel and the future of hospitality.
Speaking of office, I know one of your first ACs in the country was an office building conversion in New Orleans.
Correct.
So we've been doing that for some time, but are you seeing more office building conversions happening in your pipeline?
I think there was a lot of interest in that. They can be challenging architecturally, right? I mean, something that was built as an office to turn it into a hotel is not easy to do. And when I start talking about that stuff, it will become very clear very quickly how little I know about architecture and those things. But just the spaces don't always work out well. So you do need to kind of pick your building very carefully if you're going to think about doing something like that. And there's probably a lot more to pick from today than there might have been in the past. So the chances of finding one that might be available and that can work are certainly higher. But you do have to be careful when you sort of think about that. And I don't think we've seen a material increase in that, despite it being an obvious thought for what you can, with what you might try to do with office buildings these days. I suspect more, at least initially, we're thinking about converting into multifamily if they were going to do that. And maybe only recently a little bit more expressions of interest around hotel.
Yeah, that's right.
We've done one, and it's very painful.
Yeah, from a structure standpoint.
And not easy. The mechanicals, the footprint needs to actually line up for room bays for it to lay out and be efficient. And then you still don't know what you don't know on an old building. Mm-hmm. And once you're kind of in and tearing things out, the cake is sort of baked, if you will. So we would do one again, but we wouldn't want to do it programmatically because it's challenging. And it really needs to be the right, unique opportunity for it to work and make some sense. Yeah,
I mean, what you have is a lot of space in office buildings that you don't necessarily need for hotels, and some spaces that you do need for a hotel that may not be easy to sort of retrofit into office, right? Yeah. So yeah, I'm not surprised to hear about challenge in an individual case.
I wouldn't necessarily encourage it. That's all I'm saying.
True, concealed conditions, right? But we've done it successfully 6 or 7 times over the last 20 years.
But you've always found something. I remember you did a Hyatt House project in Jersey City.
Bank building. We like old bank buildings.
Yeah, that you found that you weren't expecting, right? To JB's point. So it takes more time.
We call those opportunities for personal growth and development.
I love that.
It's just like, we don't want to grow anymore.
We need lots and lots of contingency.
That's great. Well, now's a great time to pause for audience questions. There's 2 mics, and the conference coordinators have asked that you use them because there are people watching this online, and they won't be able to hear your question if you have one. So hopefully there are some. There's a mic right there. Mic over there. Nobody? Okay, we got one right there.
I'll break the ice here. Thanks for all the panelists' time today. Maybe a question more so for Wes and JB, but in terms of the, let's call it alternative brand concepts such as AutoCamp and whatnot, is there an appetite from a development standpoint and equity standpoint for these emerging brands that perhaps have better returns for owners to some of the readily available options?
I think anytime you're backing something new, I think you have to just make sure that you believe it's really differentiated, because I think there's a lot of new names that you could have for a hotel that is not that distinguished from another hotel. And so I think, and of course I'm sitting here, we got experts on building out all new brands that I'm sitting next to. But as an equity investor, I think what we're looking for if we're going to back a new brand is like really a competitive moat, that there is something distinct that's being created. And so that's what we get really excited about. I hope that's responsive, but there is capital organizing around it. And I think as investors, a really interesting intersection is when you have great consumer demand, but where institutional capital has not yet organized at scale, but it's at least there. You know, I think in this economy extended midscale segment, I mean, you have the Blackstone Starwood transaction. You know, with ESA, you've got the 110 Wood Springs that Brookfield sold. I mean, you have there's evidence of institutional demand. In outdoor lodging or experiential travel, I think you look to who are the companies that are backing. And so again, with Starwood backing Getaway and KSL backing Under Canvas, and we're smaller than both those other companies, but us backing AutoCamp. We are hearing a lot of interest from people saying, hey, when you've got a national portfolio, which we're just building, and those assets are stabilized, we would love to be part of the takeout because it's irreplaceable real estate. It's in markets that are really difficult to get anything done. There's moratoriums on new construction, et cetera. And so I do think that if you have that competitive mode, if there's evidence that capital is interested in coming in, we never underwrite for cap rates to expand. I'm sorry, we never underwrite for cap rates to contract. We always underwrite to have cap rates expand. But in that circumstance where institutional capital starts flooding in or at least coming in at greater scale to a new idea, cap rates tend to either stay flat or go down. So those are the circumstances, at least where we focus on something new.
Yeah, and I would say from a development point of view, alternative accommodations, which is how I kind of classify all those programs, I think they're really interesting. I would love to be able to figure it out and wrap my mind around it. Noah and Jolene over here, you know, they've done a really good job, and there's more brands, more competition every day. It feels like it gets more challenging to perform in such a hyper-competitive market. So thinking outside of the box, kind of going against the grain, targeting some of these approaches that, to your point, institutional capital hasn't flooded in and taken all the returns away from yet, is really intriguing to me, and I'd love to be in this space in the future.
Any other questions? Navraz?
Yes.
Okay.
Julianne, excellent job in leading this panel.
I agree. Excellent job, Julian. Thank you.
My question is for Julianne and for Noah. Owner profitability ultimately drives development, more so than ever before, especially seeing the data this afternoon over the last 5 years, even though top-line revenue, but what's netting to the owner continues to be under pressure. So Noah and Julianne, what is the interaction between your development teams and the operation teams at your respective brands, revenue management at your respective brands, commercial strategy, because development can't exist in a silo anymore because owner profitability is under so much pressure.
Yeah. Well, first of all, I didn't plant him to make a compliment, but thank you, Navraz. He's about to start construction on a beautiful Staybridge Suites in Ocala. I would say that we, and I don't want to speak for Noah, I'm sure we're similar though, is we put the pressure on our counterparts, right? Because we want the repeat franchisee, as Noah mentioned. We want to keep our franchise community growing, happy, coming back to the portfolio, trading up, trading down, whatever it might be. And that can only happen if they're performing, right? And we don't have control over labor rates and other things that the market sets, but we do have control over what the brand will require, the FF&E costs, and so forth. So I would say I spend half of my job speaking to owners outside of IHG, and I spend the other half of my job speaking internally to my counterparts saying, hey, what you're about to propose is going to cause X, Y, and Z, or think about this, what about taking cost out here? So I would say we're constantly putting the pressure on with our partners who are willing and open, but we're sort of the conduit to the owner community. I think most companies are set up that way.
Yeah, I think that's exactly right. You've nailed it. I mean, we have chosen the brand companies have chosen a business model that is entirely reliant on its growth, on third parties being willing to invest in hotels, first of all, right? And then invest in one of your brands over another brand, or frankly, the choice to do something independent, secondly. And so if we are not laser focused on ensuring that those investors are continuing to earn returns from that, our business starts to break apart fairly quickly, because we're not satisfied simply with the portfolio of hotels that we have in the around the globe. We want to and need to grow. So there is near constant engagement with our franchise community and the owners of the hotels that we manage to make sure that we understand the depth and challenges that all of you are facing day in and day out, and that we serve as the voice. At Marriott, I'm sure the same is true at IHG. There are a number of groups that are interacting and engaging with our owners and franchisees. Development is simply one of them, but we do serve as an important internal voice, because we hear day in and day out from owners and franchisees about the challenges that we're facing, and we need to address those and ensure that there continue to be returns, that if you do happen to have the privilege of waking up in the morning with some dollars to invest, that you are choosing to continue to do that in hotels and do it in branded hotels with one of our companies.
Thank you.
Any other questions before we wrap? All right, then I would love to go down the line and ask 2 questions of each of you. One is, what are you excited about for 2024 relative to our industry? And then, where is your next vacation?
I'll start us off. Selfishly, I would hope for a lower Fed funds rate by the end of the year. But realistically, for the industry, following some of the AI, large language model tools, our industry has historically been very slow to adopt new technology. And I think there's these emerging technologies. I don't think there's going to be a one-fits-all solution, but a lot of blocking and tackling that really improve the entire process of hospitality, from back of house, from marketing, hiring process, labor management, to guest interaction, guest service, personalization, that could really accelerate and improve our industry as a whole. And so I haven't seen anything that's amazing and blow me away yet, but I think it's going to be a lot of small incremental improvements that hopefully when we look back in 5 years, we've seen a dramatic shift and improvement in operations and overall hotel performance.
That's great.
And then for the trip, I don't have it planned yet, but the wife and I are hoping to do Machu Picchu this year. Wow. And hike the Incan Trail, which is a marathon hike over a couple of days. So we'll see if we can fit it in the calendar or not, but that's kind of the
incredible.
Exotic trip out there.
That's awesome.
My inner accountant's going to come out after that. So for me, for 2024, it's, we're just, kind of excited to see the continuation of the return to normalcy, right? The labor markets are better. We have much less contract labor in the hotels. Cost pressures are smoothing out. Contractors are starting to call and ask, what do you have coming next? Suppliers are starting to call and check on what's in the pipeline, that type of thing. So things are kind of evening out and returning to a new normal anyways. So feels like maybe through the rest of 24, the struggle from COVID hangover will be over and we'll be moving forward. I said before, I'm kind of looking forward to 25. And then next vacation for me, actually, we just put in a destination pool at our house, so I think that's our vacation for the next 20 years.
Right.
Awesome.
Nice.
Taking the value out of it.
For me, I don't know if there's anything sort of particular I'm excited about for 24. I mean, I think like a lot of us, I just really enjoy this industry. I mean, it is certainly more exciting now. Well, actually, I suppose you could use the word exciting to describe what we went through back in 20 and 21 as well, but not in a positive way. And so sort of coming through the backside of what was, kind of that body blow to the industry as a whole, and being on the other side of that, and now just being able to kind of focus on a little bit of that sense of normalcy again that that Julie was describing and enjoy the things that we have always enjoyed about working and being part of this industry is maybe for me what I'm sort of most looking forward to in 24. For the trip, so my wife and I celebrated our 30th wedding anniversary back in August of last year, and given where we wanted to go, that was not the right time of year to go there. So in about a week and a half, we're going to the Maldives, where we'll be for a week at our Ritz-Carlton, which just opened there last year. So we're super excited about that.
That's exciting.
I'll be bored after 72 hours,
Yeah.
but
I'd like to just, my vacation would just go there with we don't need to go there at the same time. You
Come
can have
along.
your 30th anniversary. I think a lot of what's been said is probably what a lot of people are feeling here. We've actually appreciated the chance to focus on operations and have just like a break where, there hasn't been a lot to do from a capital perspective. I think, the Howard Marks quote, "You can't predict, but you can prepare." This feels sort of like we're still in that like preparation phase. There's a lot coming. We're raising capital right now, so we're kind of getting prepared on that front. There's a lot of exits that we've all been waiting for the last 3 years. That assets that have been, we thought we'd sell them in 2021 or 2022. COVID and then the rise in interest rates has made that a little more challenging. And so just this idea of kind of executing on business plans that we've all been, trying to execute on for so long and seeing some of those things come to fruition, preparing for the opportunities that are ahead of us, I think are exciting. And my family, I have 5 children, and my wife and I are celebrating our 25th wedding anniversary this year, so we're a little behind you guys. But we had planned to be in both Israel and Egypt in December of this year. That obviously did not happen with all the tragedy that's happening there. We are driving to Orange County as our next vacation for spring break. So very different than the trip we had planned a few years ago. So we live in the LA area, and it'll be a much more simple execution. So staying at the Marriott Newport Coast Villas, by the way. It'll be great. So
I love it. Well, thank you very much, each of you, for sharing your wisdom and expertise. Please join me in thanking our panelists.
thank you. Thanks, Julie.